Financial futures. What is financial futures? A future contract standardized exchange tradable contract between two parties to trade a specified asset on a set date in the future at a specified price. Let's say there are two companies, Company A and Company B. Company A, as a buyer, will buy bond from the Company B, then make payment at a agreed price and agreed time in the future. There are four categories in financial futures. First, bond futures. Second, short interest rate futures. Third, stock index futures. Fourth, current futures. In the procedure, there will be a clearinghouse act as a third party where both companies will deposit an initial margin into the clearinghouse account. These margin payments will avoid the companies from suffering potential losses when there is an increasing price in the future. Additional payments of margin are made daily so that the credit risk is well managed by clearinghouse.
Next, there are several types of financial futures. Firstly, bond futures. For this contract, there must be a relationship between the contract and the cash market if it is described in terms of notional stock. Since this contract requires physical delivery, after agreed term, seller have to bring the bond certificate to buyer. As an example, the unit of trading is 100,000 ringgit with 5% coupon rate. There will be a quotation stated which will be 100 ringgit. So, 1,000 ringgit will be paid every month of the delivery month. It is useful for both companies and investors based on their own budgeting. When it has a fixed rate loan, this contract will protect against the possibility of interest rates dropping. Next is the short interest rate futures where interest rate is fixed. For example, the index stated that the price is 100 ringgit minus 3 months interest rate. So then, the future price will be 93 ringgit and 75 cent with a 6.25% interest rate. If the interest rate falls to 5% on the next day, the future price will be 95 ringgit, which is higher than the future price at 6.25% interest rate. From that, we can infer that as interest rate increases, the future price will fall. This contract allows us to lock the current interest rate to protect against any increase of interest rate in the future. Thirdly, we have stock index futures which acts like an equity or share. As an example, a company would like to buy a share of other company at the price of 1 ringgit for 1 unit. This contract allows the buyer company to lock the price to prevent themselves from any increase in the stock price in the future. Lastly is the currency futures. It requires the delivery of a set amount of given currency on a specified date. For instance, we agreed to purchase US dollar when 1 US dollar equals to 5 ringgit. So, if there is any changes towards the currency rate of US dollar or Malaysian ringgit, will not affect the contract that has been made.
In layman's term, the difference between forward contract and future contract is that future contract is a standardized exchange tradable contract, while forward contract is a privately negotiated contract. This means that if Company A wants to negotiate with Company B, under the forward contract law, they don't need to use a clearinghouse as a third party, while future contract law states that they should use a clearinghouse as a third party.
In this slide, we will be talking about option. Option is like an add-on which gives investor the power to purchase or sell a specified asset on a specified date. There are 4 types of option which are called call option, put option, American style option, and European style option. Firstly, call option gives the right to buy a specified asset on a specified date in the future for a certain price but not obligate to do so. Secondly, put option gives the right to sell a specified asset on a specified date in the future for a certain price but not obligate to do so. Thirdly, American style option is an option that can be exercised on any date before its expiry. Lastly, European style option is an option that can be exercised only at expiry. Call option and put option is commonly used, while American style option and European style option is not commonly used. Option can be used to sell or purchase when the investor is not satisfied with the profit gain. For an example, the investor can use option to protect investor against changes of market interest rate when borrowing with variable interest rate.